Welcome to the Collecting Keys Real Estate Investing Podcast with your host, Mike DeHaan and Dan Austin. From wins, losses, horror stories, and tactics for optimizing your business, Mike and Dan take a real, uncensored deep dive into the ins and outs of running a full-time real estate investment and wholesaling business.
All right. Welcome to episode 26 of the Collecting Keys Real Estate Investing Podcast.
26. Ooh.
20. Yeah. This business is like always so up and down. I was chatting with Judd today, and we were talking about some stuff, and I was like, is this what you signed up for when you decided you want to work for a real estate investing company? Because all everybody ever sees are the checks, the wins, people doing well when they follow like the Instagram bubble or they listen to a lot of these podcasts like Bigger Pockets or whatever. Like any guest that's on Bigger Pockets, all they do is talk about the fat stacks that they are making.
Ooh,
and
they're so good.
I'm still waiting for those days, man. When are we gonna start getting those easy wins?
Gosh, are they lying? Is there like a majority of people lying?
I think they're embellishing. I mean, I'm very guilty of embellishing sometimes myself, but with some of the things that people talk about, I think you are correct. There are straight up lies. And I was actually thinking about this the other day, thinking back to when I used to listen to Bigger Pockets and sort of like hits podcast a lot when there's like always just these people that were winning, and so many of those people, I wonder where they are now. Like
right?
there's a few that stuck around, then that a lot of them I followed on socials pretty much as soon as they were on that, and out of those I would say 90% of them have disappeared. So
I'm sure of it. Yeah, one in a long game. Yeah, it's hard to stick around in the long term, man. It really is. Like holy smokes.
Yeah, it's brutal. I've been thinking
how
about
would you categorize our week then? Like, well, so kind of felt like a very frictiony. Like there's a lot of friction.
Yeah. I mean, so I went over the weekend going over all of our metrics, and I was like, damn, we're like crushing it right now. And then honestly, yesterday, we just had so much shit that came around and just completely took the steam out of my sales. And I was like, this is the balance right here, for the weekend that I have where I was like feeling pretty much on top of the world. So, because we had this oil thing still with our Airbnb that's just turned into a freaking nightmare.
Yeah, the insurance claim is, man, I was firing off some nasty emails. I was getting nasty.
Hey, they were cordial. To be fair, that response that lady had was super bitchy. Like,
wait, which? Oh yeah, the like the office assistant. Yeah, and then the funny thing is, see, I'm tactful here, tactical.
Oh yeah.
Because what the guy said, their previous response was, nope, oil smell's gone. And then he said, no, I get it. There's still oil there because of this reason. I was like, boom, gotcha. Yep. So I logged that note. It's just like fine details of these insurance companies, man.
Yeah. Well, and then little things too. So, that company that we worked with, when I talked to our agent, she was like, oh yeah, we have a policy that we never ever refer them because they're just so terrible. And she was like, you're lucky you didn't get the Valley branch. They're even worse.
That's who we got, I think.
I know. Yeah, that's the Valley one. Maybe it is. Yeah, I don't know.
But, wow, I don't know because they tried to get one, and our adjuster said that one wasn't available, and so they had to go with the worst option, which we found out why. I just basically told them, I was like, I'm not paying you until it's done, and then we can talk about it. And so the insurance adjuster, I think, is also going to, hopefully, if she actually responds, she's ghosted us. I mean, she's gone. She disappeared, which is really weird.
That she ghosted our agent, too. It's not just us. Yeah. She knows she screwed up, and, she's just basically going to run from her problem now. But either way.
Well, the one thing I know about me is I have more time and money when it comes to what is the right term? Is it vindictive or being spiteful? Like I will lose money to be spiteful on some of these things just to make things correct.
Yeah. Yeah. I mean,
is that
that's
bad
fair
to say? Is that bad to say? But sometimes like when you were done wrong, and like you and I talked about it, like we did everything right, like we were following the steps, doing everything, doing the process, being super engaged in it, and then it still didn't work. And it's like, you failed. Just admit it. You failed. And then I would be happy.
Yeah. Well, and that's the thing too, is it's just neglect from an individual, like not doing their job correctly. you know, like a bunch of individuals, honestly.
Yeah.
But, you know, and I mean, and it's not being spiteful. I mean, I'm kind of the same way. It's like, so the other, you know, one of the other things we're dealing with right now is we have this property that we bought. I don't know if we already talked about this one with the owner occupant who we rented it back to, who is fully capable of paying rent. And they announced at the beginning of March they were not going to pay rent anymore. They just decided that they don't need to do that. And I was like, okay, fine. So we posted an eviction notice. We posted a 14-way notice to pay or vacate, as is required in the state. We sent in all of our stuff to the mediation center as required of the state. As soon as she got the notice, she texted me. She was like, "You don't need to get an eviction lawyer involved. It's like, it's not that bad." And I was like, "Well, you gonna pay rent then?" And she said no. So I was like, "Fine." So, you know, I filed everything. It was all moving forward.
Yeah, you have to.
You have to, right?
Cross your T's, dot your I's.
Yeah, I mean, she's like, "I'm gonna move out in the middle of April." I'm like, "I don't care. You still owe me like $3,000 for rent for these 2 units at this property." And then, sure enough, the day, and this is where just people being vindictive, right? People being malicious with their intents. She literally waited until the last day and then complied with the mediation center and set up this like bullshit meeting. We're gonna have to go and talk to her and be like, "Why didn't you pay rent?" And she's gonna be like, "Oh, well, I'm leaving next week anyway, so screw you." And what that's gonna come down to is, I guarantee you, she will move out. It will be easy, and then we're gonna sue her ass for the rent that she didn't pay, even though it will cost us more to do so. And I'm gonna do it purely because of the malicious nature of what she's done.
Right.
Because
she
she
was
thinks she's
unethical.
so smart, so unethical with so much stuff. You know, and just the malicious nature of it. I'm exactly in the same position as you're talking about with the oil spill. I'm like, I'm gonna get after it, and I don't care if it costs me $10,000 to collect, like, you know, $3,500, because she'll have a nice red stamp on her record, and you know, I'll have that in my back pocket, that at least I had some sort of justice for the incredible headache that she's caused.
I would say for our listeners out there, Mike and I are generally nice guys, and that's probably not, this is what we're explaining is probably not best business practices, but at some point in time, you just have to stand up for your principles, and you gotta do some things.
I wouldn't say they're not necessarily best business practices, maybe not the best like financial decisions.
Yeah,
When you're doing this stuff, but I mean, I don't know. With business, you gotta defend your business. You gotta do what's right by that at some point.
I would say for this one situation, we've given people 10, I don't know, probably 20 or 30 different people. We've been like, we don't care, just move out. We don't even try to collect rent, right? Because they're, you know, generally honest with their intentions. If they want to, like, if they're like, "Hey, I'm going to screw you," and they're honest about it, like, that's a totally different story.
Yeah, exactly.
Right.
Well, and there's so many things with this that have just made it not like that. I mean, the second that we closed on the property, she submitted a maintenance request to fix the sink. Okay. And we were like, okay, we're not going to do that. And then immediately after that,
well, and that's when we also thought she was going to be moving out in like 2 or 3 weeks, because she said she was, right?
Exactly.
She just needed a little bit of time to get her stuff out.
Yeah. Yeah. So that was the thing, is she requested us to fix the sink, and then she was immediately like, "Oh, I'm not going to move out until middle of April now." I'm like, "Okay, that was not what we agreed on. We bought it in January." And then right after that, she announced that she's not going to pay rent anymore. And I guess this is after she ghosted our employee, Judd, who has been trying to communicate with him, just because she decided that she didn't like him. So we had no idea what was going on for like a month, you know? And then she sends this super passive aggressive stuff. And anyway, people issues. This whole business is a people business more than anything else. And anyone that thinks that it's not is probably not making moves, or they're not, like, you know, creating opportunity. They're waiting for opportunities to come to them, and I guarantee they're not doing that much business. But
Totally people business. And we still have another people problem on our flip that we're trying to sell. I saw your post today on Instagram.
I know, man.
About I don't even know what you said, but basically don't count your chickens until the eggs have hatched. And we always say that, we know that, but man, this one was like done deal, sealed. And now we're stepping back and hopefully going to work through it, but we'll see.
Yeah. Well, I mean, this whole situation, this was really took out me yesterday, because, you know, we knew that there was a kind of potential issue here. It seemed like it was fine. And
it's a condo and condo insurance issue. We're flipping a condo, right?
Yeah.
And the condo has to have insurance for the building because there's attached units. But the condo association doesn't have sufficient insurance to get lenders, so people can't sell their condo. Or they said there was somebody that tried to refinance last year, and they're like, "Oh, sorry, you can't," because the insurance wasn't sufficient.
Yeah. And so basically what happens is everyone that owns a property in here, which is now us included, is stuck with these properties because no new buyer's lender will ever put a loan on it if they can't get sufficient insurance. So
So now
basically,
we have to play the people game, right? Now we
ex-
have to get the HOA
yeah.
president, the HOA. Yeah.
You have to play the people game, and it's going to go two ways. Basically, the HOA president is going to comply and work with us, get it changed. But if she doesn't, man, we're going to pull a straight mutiny on this thing. We're going to have to get the rest of the community involved and like overthrow the whole thing. Honestly.
Heck yeah. Let's like get a torch too.
Yeah.
Let's
Yeah.
light a torch.
Seriously.
It's like an HOA. The thing is, it's like an HOA of like, what, I don't know, 10, 12 people, 10, 12 homeowners. So like, it won't be too hard to rally the troops.
Yeah, I know exactly. Yeah, I was telling my my parents about this one actually, and I was like, yeah, we're gonna like have a mutiny on this. My mom's like, isn't that what pirates do? And I'm like, yeah, I'm a freaking pirate. Like,
Well, if she knew what this condo looked like before, it was kind of like a pirate ship. Dude. It was rough.
Pretty much, yeah. So it's just nonstop. But that just sucks because we're making business decisions, expecting like $120,000 come back between our profit and then just like our cost into this thing. And now it's like, well, that's a bunch of deals that we are gonna probably have to pass on because we're not gonna have the liquidity to do it.
Well, I mean, we won't pass on deals, right? I mean,
yeah,
potentially it could put us in a bind, but
I mean, it's going to influence our decision though when all of a sudden we don't have that much cash because realistically, what it's going to take for us to keep to buy other stuff. I mean, we have our bases still. We have the opportunity to buy things, but if something big comes along, we're going to either have to raise the money, which is fine, or we're going to have to make another capital injection to the business, which we don't necessarily want to do. Right? If we don't need to, it just throws off the equity basis and creates a fun situation.
We haven't needed to do equity injections for a while, so we're like the business is self-sustaining, but then you kind of run into these roadblocks where we have deployed a lot of capital, not just on this one project, but we have quite a few, right? And we just closing on one Thursday, and so to your point, like if we as opportunities come in, we don't ever like to give up on them because we don't have the money, which means we got to inject cash or, like you said, raise money, because we will deplete all of our business funds to do this that we should be recycling and coming in if it's all in a timely manner. But that's also the thing about flipping when you're running a flipping business as you're trying to scale, which is why scaling a flipping business is so hard, is because it is capital intensive. Yeah. I don't know about the no money down stuff people always talk about, because you and I have never found that true deal where you didn't need capital at all, right? I mean, unless you have like a private lender, which we've done those deals, but there's still some costs associated with it. But when you're trying to flip multiple properties at the same time, you've got down payments, you've got closing costs, you've got carry costs, you have rehab costs. It just adds up. And if you want to do 2, 3, 4, 5, and you have 70, 80, 100,000 deployed to 5 properties, it's $500,000, right? How many people have $500,000 starting out as a flipper? Not a whole lot.
Yeah, and even if you do find, the one, your rich friend or your uncle or whatever that's going to give you that money, realize you're still indebted to that person. Like, honestly, I don't always like being in those situations where we have those loans out from friends, things like that, because I worry about that money. Yeah. Especially with the market getting kind of frothy like it is. Things could get a little funny here, like pretty quickly. I've heard stories about people back in 2008, and they're like, yeah, you bought a property at like the first of the month, and all of a sudden at the end of the month, it was worth 30% less than what you bought it for.
Right. Yeah. I think twice about deploying my capital, but I think 3, 4, 5, 6 times when I'm deploying other people's capital.
Always. Yeah, absolutely. And I think that's where using other people's money gets kind of unethical and a little bit questionable, because, a lot of people don't seem to think that way. They think, and especially in like the syndication side of it, you see a lot of people being like, oh, well, they know the risk that they're taking and all that sort of stuff. It's like, but do they though? Do they really? Or are you just telling you that to make yourself feel better when things do get shitty?
Yeah. Yeah, they do know the risks, but depending on how you're syndicating money, they'll still sue your ass. And if it's friends and family, your relationship's going to be potentially fractured. Unless you have a benefactor that's like, yeah, if you lose it, that's okay. I don't know anybody like that though.
I don't either. Yeah, no way. You know,
Well, and typically on a lot of that, when you're raising private money in real estate, especially a lot of the syndications you and I have looked at, like the returns aren't good enough. It's not like you're investing in like an early round like startup, right? Where you're like, dude, I could 100x this money. It's like, you're looking at a 15-20%, IRR or something like that. Like that's not like worth risking part of your life savings for. And nobody's really lost the last, I don't know, 4 or 5 years. So it seems easy.
Yeah, yeah, it for sure. And I think that's where people get it gets questionable. So we're in that zone where, I mean, honestly, if you've been doing business for the past couple of years, unless you really, really screwed up, you can't lose.
Yep.
I mean, it's getting a little bit tighter now on stuff, but for the most part, nobody has been losing these past few years. And also too, one of the biggest things with when people using all these private money, and this is what really starts to get me with a lot of these people with the vanity metrics of, I own 1,000 doors or whatever like that, is, use private money, you buy these 1,000 doors at near retail value, and sure, you're an owner on paper, but you're not actually worth anything because all of the equity belongs to those people. And that's going to be my transition into what I want to talk about for the second part of the show, which is going to be cash flow versus equity, and kind of the positives and negatives of each one, and sort of like how and when you should prioritize each one. But yeah, we'll talk about that in just a second. But really quick, wanted to say some stuff about our Instant Investor program. The Instant Investor program is our 12-week group coaching program, which includes a self-driven course and access to our private investor community. We will take you through the full process of how we find our leads, how we market, how we do our sales and follow-up, and how we determine the best strategy for every opportunity that comes our way. On top of that, you will also join a community of other like-minded investors nationwide that are all marching towards the same goals, and you will have direct access to Dan and myself, so you can continue learning and growing with us as we continue to adapt and grow our business. So whether you're a new investor or already established, our systems can help take you to the next level. So if you think you might be a good fit, go to theinstantinvestorprogram.com and schedule a call, and we can have you talking to motivated leads in as little as 2 weeks. All right, Dan, cash flow versus equity. This is one of the things that I feel like is super contentious for
It's an argument
real estate investors.
as old as the ages.
Pretty much in the real estate investing space. And I think that the biggest divide in this comes between people that I would say have some semblance of financial freedom and those that don't, because how much you value each of these different metrics in real estate really sort of varies depending on your current income position and your current goals. But, because typically people that are getting started, trying to escape their 9 to 5, like their only income's coming from their W-2, cash flow is like the sexiest thing you can think of, right? Yeah. I mean, I remember back when I started, I was like, man, what would I do if I made an extra $500 a month from a rental property? Like that's so much money, and after a while, your cash flow starts to build. It's still obviously important, but you start to realize very quickly if you have a lot of, the real gains come from the equity buildup that can come from A, purchasing the property at a discount, and then B, the appreciation that happens over time. And once you get that equity built up and you're able to refinance and use that gain that you have on paper by doing doing a cash out or something like that, that's where real wealth and value comes from. And all of a sudden, if you can pull out $100,000, $200,000, $500,000 from properties that you've accumulated over the years in exchange for a few $1,000s worth of cash flow, that becomes a no-brainer.
Well, and I think the big thing that gets missed in the argument is that's tax-free income. Like, so when I'm looking at my income this year, I did a decent sized cash out refinance on some of my properties. That's tax-free income, right? I'm adding that to my income stream this year. I know a lot of people are like, well, why would you do that? You're taking on debt. It's like, yeah, but I just got all that money this year, and in 5 years, I might do it again. Which is a shift. A mindset shift from when I started was, well, if I buy a property every year for 10 years, I pay them down, that argument, and then the snowball. And then you just have your taxes and insurance and maintenance and all that sort of stuff, but the majority of that cash flow is now going to you. that is like where I started. But then you realize like how inefficient that can be. You know, and if you're just looking to replace income, then yeah, you're always hunting for cash flow, but you probably haven't been able to find a lot of it lately. So it becomes super challenging. So what do you do with all that equity you have?
Yeah, exactly. And I think that the question as well comes down to what are your, not only immediate but long-term goals, right? Because, even if you're happy with your W-2, you are not really interested in doing real estate for more than just like a passive business. You still need to find mix of both because tell you what, like a lot of people talk about these, properties in the Midwest, which I assume you can still buy. I don't know the way everything's going. I don't know if you can. They're like, oh, it's like $40,000 for this property, and it rents for $1,200 a month. The cash flow is just insane. You can go buy a bunch of those, and you're making so much cash every single month. It's like, yeah, you're true, but when that property grows 10% or 20%, that's like $4,000 or $8,000. When my $500,000 property over here, that cash flows $300 a month, grows 20%, that's 200 grand.
Yeah, that's fat. That's fat stats,
fat.
right?
Yeah,
I would argue.
You
I would argue. You mentioned
cash flow for that.
right, and I would argue too, like that. You mentioned if you have your W-2, you need a balance. Like if you have a W-2, I'd almost go a little more aggressive, especially if you're like it's a really good, secure W-2 and you're happy with that income. Like who gives a shit about the cash flow, right? As long as you're buying good quality properties that have appreciation, like that's awesome because yeah, you pick up 10 properties in 10 years and they all, break even or have some security buffer, right? After set asides and all that. Man, in 10 years, that wealth you built is way more significant than worrying about, well, I need cash flow because I'm trying to replace my W-2 income.
Yeah. Well, and I think that brings up such a valuable point that, regardless of what your goals are, you have to be looking at real estate, as an investment for the long term. If you're looking to flip a property, you're looking to wholesale, that's different. That's not an investment, that's a business. So when you're looking to do this as an investment, you have to be thinking, 7, 10, 30-year horizon on these. And like, trust me, if you're buying a cheap property that's not going to have that long-term value, it needs a lot of work. It's in a terrible area. Just so you can make, like $1,000 a month instead of 300 on that A-class property, or, even 100 off that A-class property, I guarantee you your net gains will be terrible in comparison on that cheap property versus that good property. Like sure, the immediate checks coming in, so you make $12,000 a year off of it, but the A-class property, grows, I don't know, let's say $200,000 over the next 20 years. Like it might come out to be quite the same, right? I think 12,000 times 20, would be about $200,000. The appreciation of the other one would be the same, but the CapEx, I guarantee you, on that A-class property are going to be a lot less. You're gonna have a lot less.
Far
headaches,
less.
And once you're done with it, you'll probably have a better chance of getting rid of it too.
Yep. Agreed. Yeah, I mean, you might have to buy some lower class properties when you're starting out because that's like in your zone of confidence. But like getting into those nicer areas, and like you and I have always kind of gone along the lines of like, hey, if it's a nice property today and people want it today, they're going to want it when the market shifts and it goes down. They're going to continue to want it. We're still going to be in demand. And those properties typically weather storms and come out at the other side way better, as opposed to a dilapidated neighborhood where you might have like a nice house that you renovated, but the neighborhood itself doesn't have the income socially from the community or from the county, the city, or whoever is running that, and they're letting it dilapidate, including the infrastructure, so that neighborhood's not going to continue to be maintained like an A-class, where it's going to grow and come out of a recession even stronger.
Yeah, for sure. I guess my metric for looking at that is like a baseline. If people are trying to figure out what the different neighborhoods are, I mean, everyone knows like the good neighborhoods and the bad neighborhoods, but sometimes you're in kind of the gray ones and you're like, oh, I didn't know this part of my town existed. Like, is this a good area? I don't know, especially when you're first starting out and you're just learning everywhere. My metric has always been, would I have lived here in college? As like a 19, 20-year-old college kid, you don't really need much. Like, would I have been willing to live here? And if the answer is yes, then I figure there's probably a lot of other people that would too.
Absolutely.
Because back then I did not need a lot to be happy. And, but I was also, I grew up in a small town. I went to a private university. I was pretty,
sheltered.
Yeah, sheltered, right? I wasn't going to be comfortable anywhere where there was even the slightest chance I was going to get stabbed. So for me, that was always my metric. And, that's sort of something that I've stood by, and it served me well so far.
Yeah,
But
absolutely.
yeah, so, and I also think though with those, that long-term vision like that, it's is one of the reasons people tend to get stuck on one way or the other is well, I sorry, where people sort of tend to get themselves into troubles and they focus on one or the other and they completely just miss out on both sides of it. So we also know a lot of people who are, I mean, we've met people like this who are strictly equity people to the point that they'll only buy extreme A class properties where they're now cash flow negative because they're going
Yeah.
for the long term. And that's where you're starting to get a little bit dangerous on the other end of the spectrum.
Yeah, I would say to do that, and we've kind of ran into a few different people, but the folks that I would have confidence in that are doing that typically have a different income stream, right? So this isn't going to kill them. Right? They're taking some risks. They could go into other assets, and they probably are invested in other assets that are either lower or higher risk, and they're going to deploy their capital because they need to do it in a smart way. And for you, if like you have a high income, another revenue coming in from a business that you own, like you want to park some money and you want it to be in a nicer area that's going to appreciate because it's going to be less of a headache for you. Like you and I know, like landlording on a large scale is pretty taxing. It's a lot to do. And it's like at some point you graduate from that and you're like, no, I don't do that anymore. And the risk of the appreciation gain, because you have the ability to deploy your capital, like is reduced, right? So if you can deploy your capital for 5 and 10 years and that's your game, that's your horizon, you're always going to win in real estate.
Yeah. Yeah, that's very true. I mean, and at the end of the day, though, the most important thing that matters is you make your money when you buy, regardless of cash equity. If you're buying poorly, you're buying too high, you're throwing away so much of the potential in that deal right away.
Right.
And that's the biggest thing that I'm concerned about with everyone that's buying things now. And I mean, I was saying the last thing last summer, and the properties have still gone up 20% since then. But as things start to get outrageous and it points approaches that frenzy mode, what they've always said is once your hairdresser and cab driver start talking about something, it's probably nearing the bubble level. Tell you what, hairdressers and taxi drivers have been quitting their job to go and be realtors for like the last 3 years. It's getting real hairy. I know so many people that have given up, full on careers that they've had for 10 years to go and be a realtor now.
It's a hard game to be a realtor right now. Sorry, who for all you people that quit your jobs to be realtors, it's tough out there.
Yeah, and I mean, just point being with that, just be cautious and make sure that whether you're buying for cash flow and for equity, make sure you're buying for something that you can see now and not something that you hope happens in the future.
Absolutely, I don't speculate. I don't like that.
You don't speculate.
And I would say, like, maybe just speak specifically about our portfolio. Like, we've been able to buy solid cash flow and also appreciation. We're kind of a secondary market in a coastal market, so that's good. I never used to think that, like, I always used to think, these coastal markets, they're just crazy. San Francisco, all these sorts of things. Guys are getting things for zero cash flow, but then they make $500,000 over 2 years. But we're slightly into that category as a coastal market compared to some of the other markets we're actually investing in now. And so looking at what we've done, I think last time I checked, our average per door was pretty solid, more cash flow than we would have thought or that we were actually shooting for. But then we also got a ton of equity on all these plays. And so that's huge. And I think that goes back to what you said is like buying right. And you talk about all these, gurus and talking figures, whoever it is, like if you're talking to somebody that's in real estate, they're going to keep telling you to buy. And then you're going to have all these other opposing arguments of like, why should you not buy right now? I play along the lines just like I do in the equity stock market, like just consistently buying. I'm just consistently in the game because like I don't try to buy dips. I don't try to buy, sell at the spikes. I'm not smart enough. I don't have enough time to do that. But I know if I can consistently buy and if it's a good deal today, it's still going to be a good deal tomorrow, just based on the way we look at our deals. And there is a balance for us personally. It does need to cash flow something for us to make it worth it, for us to manage it and for us to bring it into our portfolio. But that is not like the end all be all. We aren't like, oh man, if it doesn't cash flow like $1,000 a month, we're just not going to touch it. Like that's not how we are. We definitely look at deals that if we can burr all of our money out of it and it still cash flows a couple $100 a month, that's pretty cool. Like that's an ideal spot for us to be in. And that's what we shoot for. And fortunately, so far we've overshot all of those metrics.
Yeah. And, that goes back to having that long-term time horizon as well. Right. I mean, at the end of the day, if you're consistently buying over a long period of time, you will be successful in this, unless you really, really buy some dogs, or you buy super high, you overbuy, because that's kind of what it goes back to is we're buying at a discount, so by doing so, we're able to control our payment. If we did want to refinance out less than the maximum amount, we could do that if we were trying to get some more cash flow. We haven't needed to do that because generally we've been able to cash out all of our money plus more and still get the cash flow that we needed. And even if it's a couple $100 a month, who cares? Because we're now playing with house money, but refinanced all of our money, and then the ones that we do have to leave some money in, like we did a refinance today that I think we ended up having to leave like $9,000 in, but we're gonna make like $500 to $600 a month on it. So it's like, cool, we're gonna have that money completely recovered in just over a year.
So and it's kind of probably a little bit of a mind shift from when we started out, which we were pretty cash flow, like we were cash is king type mentality. But now that we have a large enough portfolio that if we do have properties that underperform, like one that has an oil leak and doesn't generate any revenue for months, like we're okay with that because we're looking at that portfolio as an asset and what it's going to look like in 5, 7, 10 years, as opposed to how much income can that bring. And that's because we've looked at other ways to create income that are actually quite a bit more income potential than you can from cash flow from properties, unless you're going, thousands of doors. But looking at it that way, I always say, like, there's a sweet spot where you've de-risked yourself by having enough properties that they can kind of consume any damages or any risks that are coming at you, market dependent or tenant dependent or whatever.
And that for sure, and that's the benefit of scale. When you reach that point, and where it does get hairy is when you're starting out and you don't have that yet. I mean, going back to the when I was a solo show and I was flipping properties myself. I mean, I got in big trouble on one of my properties because there were issues with it, and I did not have I had cash reserves, so I was able to survive, but I did not have the income to cover the costs that I was dealing with on that.
I remember that. That was pretty tight.
That was not
not good tight, not good tight like bad tight.
Yeah, it was really it was really bad. So
Skinny times.
And that's kind of the risk you got to take though, right? But once you overcome that hump and you can get to kind of that long-term horizon is really when you can start to see the benefits of what you're doing, and honestly in a relatively safe way too. I mean, right now it would take something pretty catastrophic for us to have major issues with our portfolio. I mean, right now we have tenants not paying in some of the stuff that we're dealing with. Some of the recent things we bought, we have these ones that aren't generating revenue at all. But overall everything else just sort of carries that, so it's kind of like it is what it is. You don't even necessarily see it.
Well, and again, it goes back to that long-term appreciation play that we look at too. And that's why we're like that, as opposed to, man, we need this cash flow to grow our business. We have other revenue generating activities with our wholesaling business and flipping that we actually can get some pretty significant income from. And, I think that even if you get to like 3 or 4 properties that are all cash flowing like $200 a door, like you're pretty secure. Like you can absorb quite a bit. If you're trying to live off that cash flow, you're probably living in a van doing the whole thing. But like, hey, you should be able to survive that. Like if one tenant doesn't pay for a year, like you should be okay.
Yeah, hey, don't knock on those vans, man. That's like the dream for millennials these days, dude. They got like LVP flooring. They got like tiled showers in those things. Yeah. They're nicer than most of the properties.
They drive like 35 on the freeway.
No, they don't drive at all. It just sits in their mom and dad's backyard, but it looks dope. Yeah. Oh, man. So cool. All right. Any last bits on that, Dan?
No, that's good. I think I will just share my quick little tidbit is I used to always be cash flow heavy. Like I need cash flow. But now I'm more like long-term mindset of, that cash flow is great and I'm going to take it anytime I can. And I'm not going to put myself in a risky position by having negative cash flow. But like that appreciation is just so much more powerful in the long term than cash flow. So you got to look at both.
Yeah.
Is that the answer? You got to look at both. I don't know.
That appreciation and equity position down the line is going to more than likely, especially if the market's, the way the market's been going too. That's, I think it's easy for us to say that because the market's gone so silly. But like overall, those gains are probably going to be more than just like the cash flow every single month that you get. So, point being, they're both important, but don't discount the equity and the appreciation position just for that cash flow, which a lot of people tend to do. So cool. All right. Well, that's it, guys. Thanks for listening. You can follow me on Instagram at Mike_invests. You can follow Dan at InvestormanDan. Go ahead and shoot us some DMs on there. You can follow the show at Collecting Keys Podcast on Instagram. We've tried to do some pretty cool highlight stuff on there. That's actually getting some pretty decent views. Like the reels, we're getting like 3,000 to 4,000 views on those postings.
We're influencers, basically.
We're influencers,
and we're not even showing our butts or our. Yeah.
I mean, maybe we should though. We would grow way faster.
Yeah, some topless videos of us working out. Yeah.
Better be careful. Might start popping up here pretty soon if we decide we want to go too quickly. But yeah, if you enjoy the show, go ahead and download our episode. Go and download every single one. Just delete them off our phone. We're told by our producers that will get the most gain in our in the algorithms for the podcast.
The algorithms, yeah, those things, yeah. Yeah, download.
Download everything. Delete them all.
Did you start downloading your podcasts? Do you download them?
I do
exactly.
To help our metrics.
Yeah, exactly.
So, and then go and subscribe. That's the other thing that's really, really important. So download, subscribe. And besides that, anything else, Dan?
No. I will sign us off I know when this airs, it probably won't be as relevant, but it's very relevant in my heart right now. But Gonzaga didn't make it past Sweet 16 and they lost to Arkansas, those stinking hillbillies.
Yeah.
We have a good team. We just didn't make it. It's kind of the story for Gonzaga, our alma mater. So I hold it tight. So I'll sign off as a loser this time, but next year we'll be there, Final Four.
Let's put something really that's going to be not relevant when this comes out next week. Did you see Will Smith slap Chris Rock yesterday?
I did. I think Chris Rock paid Will Smith to do it because he's becoming irrelevant in the comedic realm and he needs a boost. I think there's something going on there.
I 100% agree. I think the whole thing was a setup for people to just
that would never happen. That would never. Or it was either that. Was this what was this, like MTV Music Awards, Oscar,
it was
Emmys
the Oscars.
Or something like that?
No one cares about it. It's 100%.
Nobody cares about it. So I think it's a media buzz. So now people are going to watch because they don't know. It could be a brawl out there. I mean, this is like the group of the most liberal, like, loving type, actors and music artists. Like they're like, no war, love, peace, all that. And they go up and get into physical altercation. I call bullshit.
Yeah, no way. Yeah, I agree. So anyway, if you're a meme warrior out there, I've seen some pretty funny ass memes. So keep those up. So, all right, guys. Thanks so much. Talk to you guys next week.
Thanks for listening. Please leave us a review on iTunes or wherever you get your podcasts. And check us out at collectingkeyspodcast.com for tips and guides on starting your own real estate investment and wholesaling business.